These are the slides from Module F. We'll be talking about cash flows and valuation. Discounting cash flows is really the easy part of what we deal with in finance. The hard part is computing what the correct cash flow is going to be. The thing that finance majors wind up doing is trying to predict the future. And we know it's not going to be perfect. We know it's going to be accurate plus or minus a certain amount. So the thing that you need to do if you're going to work on any sort of a prediction process is you need to improve your ability to predict the future. We need to work with some sort of a base. So we're going to be working with accounting numbers, and we're going to use those numbers to try to show some sort of economic reality and then determine what the present value of something is based on future accounting figures. For that, you have to understand what the figures represent and what went into them before you can produce an accurate valuation. We're going to spend a little bit of time reviewing the financial statements, particularly the income statement, balance sheet, and statement of cash flows. And from this, you'll be computing information that you'll be using to discount the value of an entire project. Applications for this will include working with financial statements to evaluate an existing business and using pro forma financials to evaluate proposals and scenarios. A pro forma financial statement is something which is in the form of a financial statement. That's what the Latin expression pro forma means, is in the form of. And if we're working with information which is presented in the form of an income statement, what it means is we're presenting information that hasn't happened yet, but in a format that we can understand relative to profit and loss. We may need to measure and manage a company's sensitivity to a particular set of inputs or a project's sensitivity to a particular set of inputs. And so we'll need to identify what's important in this process. Now we'll be covering more about sensitivity and scenario analysis as we get into the last module in the class. But for now we just need to know how to detail out the cash flows that we're going to be discounting. When you think about what cash flow stockholders really buy, we have to strongly consider some of the models that we use to value things in finance. The dividend discount model suggests that dividends are the cash flow that stockholders really care about, but we know that's not quite true because shares of stock get sold eventually, so we know that that sale value of the stock is going to also be relevant in addition to the dividend. We know that the net income is important to shareholders. If a company isn't making a profit, it's not worthwhile, but we can't really say that that's the cash flow that shareholders are paying for because they don't have access to all of the net income. And so we arrive at the idea of something called free cash flow. It's that cash flow which is produced by the company, which is available to satisfy the needs of lenders and the wants of investors, but isn't necessarily all distributed. It's available to the company, which is why we say it's free. And to understand this cash flow, we're going to need to dig into the financial statements and what they represent. There are going to be some moving pieces that we'll have to deal with in computing cash flows. For one, we'll be talking about something called NOPAT, which is also called net operating profit after taxes. This is simply our after-tax EBIT figure. We'll take the dollars in EBIT and we'll reduce it by the amount of something called the tax shield. The tax shield, which you ran into in your WACC computations, is simply 1 minus the tax rate. So if we have a company with an EBIT of $100 and a 40% tax rate, their net operating profit after taxes is going to be $60. The operating cash flow is the next thing that we really want to get at. This is the first major milestone that we're going to arrive at in computing actual cash flows. And what we're going to do for that is we're going to take our NOPAT and add depreciation back in. Depreciation reduces the EBIT a company has, but it's a non-cash expense. And what we're trying to get at is cash flow. So we're going to take all of our non-cash items and we're going to add those back into that net operating profit after taxes to determine what the cash is that's been produced by this. This is going to be very similar to taking net income and adding interest and adding depreciation expense back to it. And there's a certain application that we use for that second formula, but for this class we're going to be using the top formula. We'll be using the one that says NOPAT plus depreciation expense. Finance majors, you need to pay attention to that second formula when you get into later classes, particularly when you're dealing with asset valuation in Finance 449. That's the formula that you'll be using, is net income plus interest plus depreciation expense. And there are particular reasons that we use the other formula, but we'll get into those when it's relevant. Again, for this class, operating cash flow is going to be NOPAT plus depreciation expense. You may recall on the statement of cash flows that there's a line that says cash flow from operations, which some people will also label operating cash flow. Operating cash flow, as we use it in finance, is not the same as cash flow from operations. The number that appears on the statement of cash flows is not the same thing that we're dealing with when we're trying to figure out our operating cash flow for the company. We can't use those two figures interchangeably, even though the labels are a little bit confusing. The free cash flow, which is what we're really trying to get at, is, as I said, the cash which is generated by the company available to satisfy the needs of lenders and the wants of investors. And how we're going to arrive at that number is to take our operating cash flow and we'll subtract out whatever our net cash investment in operating capital is. Now, let me talk about each of these points in turn. First of all, the cash generated which is available to satisfy the needs of lenders and the wants of investors. We're really looking at the cash that's available to do two things. The needs of the lenders are twofold. Number one, they want to get their interest payments on time. And number two, they want to get their principal repaid at the appropriate time. So the cash that's generated to satisfy the needs of lenders is going to cover our interest payments and our principal repayments. But they're not taken out of our free cash flow. They're still contained in free cash flow. Free cash flow is before we've paid out any of our debt service. The other part of that definition is that it satisfies the wants of investors, or rather that it's cash generated available to satisfy the wants of investors. The wants of investors are some sort of a reasonable payout, either a dividend payment or a repurchase of stock by the company. So the investors are looking for a payout in the form of dividends. And again, free cash flow represents cash which is available to satisfy the wants of investors. But we haven't taken our dividends and our share repurchases out of that number yet. So free cash flow includes all of the cash which is available to pay off interest and principal and to pay out dividends and make stock repurchases. The net cash investment in operating capital is that cash which is going to be reinvested in the company. It's cash which is going to be plugged back into the company in order to support and promote growth. And we're going to be looking at this in terms of what the operating capital is that the company is working with. Total capital contained in a company are the total assets the company has. And the operating capital are going to be those operating assets the company is focusing on. And what we're really looking at is the net cash investment in operating capital. Assets come from one of two sources. They either come from debt or from equity. If we're looking, for example, at the purchase of a large piece of equipment, that would certainly be a part of the operating capital the company has. But if they got that fund partly from debt and partly from equity, we need to understand what the source of funds was. And we need to look at how much cash the company actually invested in that piece of equipment. There's another milestone which kind of comes after this. And again, this is more for the finance majors. The free cash flow for equity is something which is going to talk about the cash flow just available to satisfy the wants of investors. We're not going to go into that in great detail here, but it's important to recognize that if you're really trying to value, for example, the equity stake in a company or the value of a share of stock, it's free cash flow for equity that's going to be focused on. For this class, we'll be focusing on free cash flow.